There's a letter that shows up in millions of American mailboxes every November. It's from Social Security. And for some retirees, it says something that makes no sense at all. Your Medicare premium is going up by hundreds of dollars a month. Not because premiums rose for everyone, not because you did anything wrong this year, because of something you did 2 years ago, something that felt smart at the time. Selling a property, converting an IRA, taking one big withdrawal. It's called IRMAA, the Income-Related Monthly Adjustment Amount. And here's what it can do. One crossed line on a tax return, and a married couple pays more than $2,300 in extra Medicare premiums the following year. Over $1? Yes, sometimes over literally $1. In the last video, I showed you the Medicare penalty that never goes away. Today's surprise is different. It's not permanent, and that's the good news. But it's sneakier, because it's decided before you ever see it coming, on a tax return you filed years ago. Stay with me, because IRMAA is one of the few retirement traps you can genuinely plan your way around, if you know where the lines are. I'm Harlan. Welcome back to Retire with Harlan, your guide to real-world retirement. Let's get into it. Here's why this video matters even if you think you're not high income. IRMAA doesn't care about your salary. You're probably retired. It cares about your taxable income in a single year. And ordinary retirees cross the line all the time without noticing. The year you sell a rental property. The year you do a big Roth conversion. The year required withdrawals from your IRA stack on top of everything else. By the end of this video, you'll know exactly where the 2026 income lines are, why the bill arrives 2 years late, the $1 cliff that makes this trap so expensive, and the 3 legal ways people manage around it, including a 1-page form that makes IRMAA disappear for the most common situation of all. Grab a pen. There's a table coming you'll want to keep. So what exactly is IRMAA? Think of it this way. Medicare Part B has a standard premium, $202.90 a month in 2026. Most people pay exactly that. But if your income is above a certain line, Medicare adds a surcharge on top. Not a tax, not a penalty, an adjustment, that's the polite word. And it applies to both Part B and your drug coverage, Part D. Here are the lines for 2026. For a single filer, income up to $109,000, you pay the standard premium. Cross $109,000 and your Part B premium jumps to $284.10. That's $81.20 more every month, plus another $14.50 a month on your drug plan. Higher tiers climb from there, $405, $527, $649, all the way to $689.90 a month at the top. For married couples filing jointly, the lines are doubled. The first one sits at $218,000. But here's the detail that doubles the pain. IRMAA is charged per person. If you and your spouse are both on Medicare, you both pay the surcharge. That first tier, $95.70 a month each between Part B and Part D, comes to more than $2,200 a year for the two of you. That's the number from the title. And that's just Tier 1. One more definition, because it decides everything. The income Medicare looks at is your MAGI, Modified Adjusted Gross Income. For IRMAA, that's simply your adjusted gross income plus any tax-exempt interest like municipal bond interest. Yes, even your tax-free bond income counts here, remember that. And a quick word about the Part D piece because it surprises people twice. That drug plan surcharge isn't collected by your drug plan. It's billed separately, by Medicare itself, usually deducted right from your Social Security check. Which leads to a strange result. You can shop carefully and find a Part D plan with a $0 premium and still owe Medicare $14.50 a month on it, or more because of IRMAA. The surcharge follows you, not the plan. No plan shopping gets you out of it. Only your income does. Now, most retirees never pay IRMAA at all. It touches a minority. But that minority grows every year because retirement account balances and home prices have grown a lot faster than these thresholds. And more importantly, even people who never pay it in a normal year can trip it in one unusual year. That's exactly the kind of year we're about to talk about. Now the part that catches everyone. The timing. Medicare doesn't look at this year's income, it looks at your tax return from 2 years ago. Your 2026 premiums are based on your 2024 magi. Think about what that means for a minute. The things you did in 2024, a Roth conversion, a home sale, one last big year of work, those decisions are showing up on your Medicare bill now, long after you've forgotten them. The letter from Social Security arrives in November or December, states your new premium for next year, and cites a tax return you filed so long ago you have to go dig it out to remember what happened. And here's the sentence I want you to underline, because almost nobody says it plainly. Your Medicare premium at 65 is decided by your income at 63. The IRMAA planning window doesn't open when you enroll in Medicare. It opens 2 years earlier. If you're 62 or 63 right now and planning big financial moves before enrolling, this video is arriving at exactly the right time. When that November letter does arrive, don't just file it away in frustration. Read the middle paragraph, the one that names the tax year they used. Check it against your own records. Once in a while, the IRS data Social Security receives is stale. Maybe you filed an amended return that lowered your income. Maybe they reached back an extra year because your newest return wasn't processed yet. If the year or the number is wrong, you can contact Social Security and ask them to redo the math with the correct return. That's not even an appeal, just a correction. And if the number is right, but your life has changed, retirement, widowhood, divorce, keep watching, because that cure is coming in a few minutes. Now let me show you why financial planners call these lines cliffs, not slopes. Most of the tax code phases in gradually. Earn $1 more, pay a few more cents. IRMAA doesn't work that way. Cross a threshold by $1 and you owe the entire surcharge for the entire year. A single retiree with MAGI of $109,000 pays the standard premium. Her neighbor with $109,001, $1 more, pays $1,148 more in premiums that year. $1 of income over $1,000 of cost. For a couple, that same single dollar costs about $2,300. There is no other line in retirement finance where $1 matters this much. That's the one IRMAA mistake from the title. It's not doing a Roth conversion. Conversions are often smart. It's doing one without checking the lines first, landing at $110,000 when $108,000 would have bought the same strategy without the surcharge. So what actually pushes ordinary retirees over these lines? 4 things over and over. Number 1, the big Roth conversion. You retire, your bracket drops, and, exactly like $50,000 in a single year, and you may vault past not 1, but 2 IRMAA tiers. The same conversion, spread across 3 calendar years and parked just under the line each year, can trigger nothing at all. Number 2, selling something big. A rental property, a business, a vacation home, even a stock position you've held for 30 years. Capital gains are income for IRMAA purposes. A retiree with $60,000 of ordinary income sells a rental with $80,000 of gains and just crossed the cliff without ever feeling rich. Number 3, RMD stacking. Once required minimum distributions begin at 73, they arrive whether you need them or not, and they land on top of Social Security, pensions, and dividends. A large untouched IRA can push its owner across an IRMAA line every single year. That's the compounding argument for the early conversions we talked about in video 1 of this series. Number 4. The last fat year of work. Retire in June at 65 after half a year of your best salary ever, plus a payout of unused vacation, maybe a severance. That final W-2 year can be your highest income year in a decade. And it sets your Medicare premium for 2 years later, when you're fully retired and living on far less. Unfair? Completely. But, and here's the good news I've been saving, this exact situation is the one IRMAA problem with an official one-page cure. Hold that thought for 2 minutes. Let me make this concrete with 2 retirees. Ray and Ellen, both 66, both single, both with about $60,000 a year of pension and Social Security, and both sitting on traditional IRAs they want to convert to Roth before RMDs begin. Same goal, convert about $150,000. Same accounts, same intention. Ray does it the decisive way. 1 year, 1 conversion, done. $150,000 converted in 2024. Feels efficient. His 2026 Part B premium is $527.50 a month, plus $60.40 on Part D. Compared to the standard premium, Ray pays roughly $3,900 more that year, an invisible tax on a conversion he made 2 years earlier. He calls Social Security to protest. They pull up his 2024 return. The math is the math. Ellen converts the same $150,000 in 3 slices of $50,000 across 3 calendar years. Each year before she pulls the trigger, she and her tax preparer run one 5-minute check. Where does this land my Magi against this year's IRMAA line? Each year the answer comes back, comfortably under. Her November letters never change. Total IRMAA paid across all 3 years? 0. Same money, same strategy. The only difference was the calendar, and one 5-minute question asked before the transaction instead of 2 years after. So here's your toolkit. 3 moves from planning to cure. Move 1, know where the lines are, starting at 63. Every fall the new thresholds come out. Before any big conversion, sale, or withdrawal, run the 5-minute check Ellen ran. Add up this year's expected Magi and see how much room is left under the next line. Planners even leave a safety buffer, $5,000 to $10,000 under the cliff, because a surprise dividend in December can push you over. If a move would cross a line, ask, can it split across 2 years? Can it wait? Move 2. If you're 70 and a half or older and give to charity, use QCDs. A qualified charitable distribution goes straight from your IRA to the charity and never appears in your income at all. Same gift, same good cause, but unlike writing a check, it lowers the very Magi that IRMAA measures. For charitable retirees bumping against a threshold, this is the cleanest dial there is. And yes, this is the same tool that diffuses the tax torpedo. It's the Swiss Army knife of retirement accounts. Move 3. The one-page cure. Form SSA 44. Remember the retiree whose last fat working year set their premium? Social Security has an official fix for exactly this. If your income has dropped because of a life-changing event and stopping work is on the list, you can file Form SSA 44 and ask them to use your current lower income instead of the 2-year-old return. Retire in 2025? Get an IRMAA letter based on your big 2024 salary? File the form, show your income now, and that surcharge can be reduced or erased. This is the single most successful IRMAA appeal there is, and most people who qualify never file it. One honest warning to balance that out. A big Roth conversion or a one-time capital gain is not a life-changing event. You can't convert $150,000, get the letter, and appeal your way out, Social Security will politely decline. The form cures life events, not investment decisions. For those, the only cure is planning ahead, which is why this video exists. And one piece of genuine comfort? IRMAA is redecided every single year. It's not the Part B penalty from my last video. Nothing here is permanent. One expensive year gives you one expensive letter, and when your income steps back down, so does your premium. Here's your action step tonight. 10 minutes, one tax return. Pull out your 2024 return. Find your adjusted gross income, add any tax-exempt interest, and write that number down. That's the magi that sets your 2026 premium. Now compare it to the lines. 109,000 single, 218 married. Under the line, you're clean this year, and now you know your headroom for the next conversion or sale. Over the line because you were still working in 2024 but have since retired? That's not a sentence, that's a form. Download SSA-44 from ssa.gov or call 1-800-772-1213. And if you're 63 or 64 planning a big move this year, you now know to check this year's lines before you sign anything. The retirees who pay the most IRMAA aren't the richest ones. They're the ones who never knew the lines existed. As of tonight, that's no longer you. If this connected some dots, 3 quick things. Tap like. There's someone about to do a 6-figure Roth conversion this month who needs to see the cliff before they jump. Subscribe, because this video and the last one are part of a Medicare and Health Costs series. Next up, the 8-month window after retirement that most people miss, and it pairs with everything you just learned. And in the comments, type the word cliff and tell me, have you ever gotten one of those November letters? Your stories decide what I dig into next. Remember, in retirement, it's not what you make that matters. It's what you keep. I'm Harlan. I'll see you in the next one.